This is the US Federal Reserve's model that estimates the probability of a recession happening within the next 12 months. And it has just flashed a major signal that we've only witnessed 11 times going back to 1960. Now, you might be confused seeing this model show that the probability of a recession is actually going down today, despite the widespread panic around a recession that we've been seeing over the last few weeks as a result of Donald Trump's tariff policies, and at the same time witnessing the largest stock market decline in over 3 years. By the way, we are doing a big discount on our service for St. Patrick's Day. This is something we do every year that gives you guys access to our premium service at a discounted price. We show you guys through all of our trading decisions step by step and give you all the context and education you need to increase your profitability in markets. This model transforms the US yield curve, which is based on bond spreads, into a tool that evaluates the likelihood of a recession playing out within the next 12 months. And today it's as relevant as ever given the widespread concerns on a recession that we're seeing as a result of Donald Trump's tariff policies. Every time that this model crosses above 20%, it means that bond spreads are in a posture that makes a recession likely to happen in the near future. Or in other words, that the credit market is tight. And going back to 1960, it does have a pretty good track record at predicting when a recession is going to happen. At least every single recession that we've had going back to 1960 has been accompanied by a rising probability of a recession on this model. When the recession probability on this model is low, it means that bond spreads are suggesting credit conditions are loose, and that's an environment where the economy can do well. We can see quite clearly all of these moments where this model is low correspond to periods outside of economic recessions, outside of these gray bars. Now, the signal we have today is not particularly low. We're still at about 20% probability of a recession, but we've seen this model go rapidly from showing an elevated probability of a recession to a low probability of a recession. To us, the first thought in the back of our minds is that we're seeing one of the biggest macro recession indicators no longer flashing a recession signal. The elevated probability of a recession was something that made us concerned throughout 2024 and kept us on our toes regarding the possibility of one occurring. So now this big decline in the recession calculated by the yield curve is absolutely something that we want to be paying attention to. There's been quite a few similar instances going back to 1960, and as you can see, most of these have actually occurred after recessions. That's because in most cases, the tight conditions from the yield curve did trigger a recession, and once the downturn materialized, credit conditions loosened back up, providing the right conditions for an economic boom to occur. But that's what makes this signal quite different from the rest, because we never actually saw a recession trigger, despite this model going above 20%. Now, there's only a couple of episodes where this exact scenario has happened in history. We saw it once in 1999 and once in 1967. Both of these saw this model go up above the 20% threshold, but did not immediately trigger a recession. And in both of these cases, credit conditions loosened back up again. So let's take a quick look at what happened to the S&P 500 in these episodes. And this is what it looks like. In both cases, the stock market did move higher in the immediate aftermath. This reading occurred in September of 1999, and the stock market actually rose by another 20% over the 12 months that followed. Now, that did eventually lead to a huge market top in 2000, as the stock market was plunged into a bear market in 2001 and 2002. And in 1967, we have a very similar scenario where the S&P 500 also rose by 20% in the 2 years that followed. Again, that eventually did mark a pretty significant market peak, with the S&P 500 dropping by 30% in the next downturn. So what's the conclusion from all of this? Well, in both of these cases, there was indeed no recession that occurred within the next year, and the stock market performed quite well as a result. Now, in both of these cases, however, a recession was not that far out, and the next downturn was quite painful for the US stock market. So to people concerned about all of these recession headlines and the recent stock market decline, this message from the Federal Reserve's own recession probability model could perhaps be a reassuring sign for the coming year. We certainly find this to be the case, because despite all the economic uncertainty from Donald Trump's current policies, the yield curve, which is one of the most powerful macro forces, is no longer sending a recessionary warning sign. And this is actually in agreement with a real economic data that we're getting on the ground. For instance, this is a chart that shows us how hard it is for small businesses to get credit. One of the things you typically see heading into economic recessions is that small businesses report that it's harder for them to get credit. Indeed, if it's harder for you to borrow money, it's less likely that you're going to expand your operations, hire new workers. Instead, you're more likely to adopt a more defensive business strategy, which could lead to an economic downturn. Again, in 2023 and 2024, we had small businesses that were reporting credit was harder to get. This wasn't a particularly constructive sign for economic growth in 2024, and again, it kept us on our toes regarding the possibility of a recession. But today, small businesses are reporting that credit is actually easier to get than it was a year ago. This type of big decline is a positive sign for the economy and not something you typically see heading into recessions. So underneath the surface, we're not seeing signs of an imminent economic recession. And obviously that goes against the current price action that we're seeing on the S&P 500. That could mean the recent correction that we've seen on the S&P is a great buying opportunity for stocks for the next year. But as traders, when we have the price action go against our own analysis, that's a signal for us to be open-minded and flexible to other possibilities and not staying stuck on just one vision. The key to successful trading is not being right 100% of the time. Nobody is able to do that. The real secret is that when you are wrong, you're able to shift your strategy in a way that limits the damage. We've seen the S&P 500 break through all of its key moving averages in the recent correction, which is very different to all of the corrections that we had throughout 2024, which had been fantastic opportunities for us to buy the dip on the stock market and expected to perform well in the short term. With such a technical breakdown, short-term market performance comes more into question. And the truth is, going back to 2010, we've had many stock market corrections larger than 10% that have occurred outside of economic recessions. So even if we are 100% correct about a recession not happening in 2025, as the yield curve currently suggests, that doesn't mean we can't see more short-term market volatility. So at Bravos Research, we'll be closely looking at the next stock market bounce to understand if we should be getting a lot more defensive with our positioning, perhaps even considering a shorting opportunity on the market, or whether we're seeing enough evidence of the market reflecting strong economic data and potentially reaching all-time highs again. If you want to follow our entire trading strategy, all of our buying and selling decisions, don't forget we're doing a discount for St. Patrick's Day. I hope to see you on the website.